We're always told that investing has to be this super complicated full-time job, right? You've got to find the next hot stock, watch the market every second of the day, and react to every single headline. But what if the most successful path, the one that actually works, is also the simplest? Well, today, we're going to cut through all of that noise and give you a clear, logical blueprint to your first million. Let's get right into it.
This right here, this single fact, is the heart of our entire strategy. And look, this isn't an opinion. This is a cold, hard, well-documented truth. Over a 15-year stretch, the vast majority of these highly paid professionals, with their huge teams and their supercomputers, they still fail to do better than the market average. Which, of course, brings up a really important question.
Exactly. Think about that. If the people whose entire job, their entire career is to beat the market, can't pull it off consistently, the idea that we can do it with a few minutes here and there, well, it's just a losing game. It's a game that's pretty much rigged against the individual investor. So you know what? It's time to stop playing their game and start playing a much smarter one.
And that's exactly where this strategy becomes so powerful. Instead of trying to find that one tiny needle in a giant haystack, we're just going to buy the whole haystack. The philosophy we push here at Logic Mint is built on one core idea. Complexity is the enemy of execution. Seriously, the more complicated your strategy is, the more ways it can go wrong.
I mean, this slide really says it all, doesn't it? The conventional way, the Wall Street way, they sell you on complexity because that justifies their high fees. It keeps you stressed out and it keeps you making emotional decisions. Our alternative is the polar opposite. It's all about being ruthlessly consistent, keeping your costs as close to zero as possible, and making the whole process so simple that it just becomes automatic.
Hear about a 1% management fee and it sounds so tiny, right? It's just 1%. But over 30 years of compounding, that single little percentage point can literally steal over $300,000 from your retirement fund. It is without a doubt the single biggest destroyer of wealth that most investors just completely ignore.
So our logical path is built on these three essential pillars. We call it the holy trinity of investing. First, you need a growth engine to really power your portfolio forward. Then you need an income safety net for when the markets inevitably get shaky. And finally, you need an insurance policy that acts as a global shield. With just these three, you have a complete, robust, and really powerful strategy.
Okay, so let's pop the hood and get into the specifics of this three-fund engine. We're going to break down each one of these funds, these ETFs, so you don't just understand what they are, but you get the powerful logic behind why they work together so incredibly well.
All right, pillar number one. This is the core engine of your entire portfolio, and its name is VOO. This is your main growth vehicle, and it's designed to capture the incredible innovative power of the American economy. Let's see how it does that.
So when you buy one share of VOO, you're not just buying a stock. You're buying a tiny piece of the 500 largest, most profitable companies in the United States. It is a direct bet on American innovation. It's a strategy that even Warren Buffett himself advises for most people. And the cost? Get this, an expense ratio of 0.03%. That's just $3 for every $10,000 you invest. It's basically free.
Okay, but VOO is 100% US stocks. And if the market crashes, and it will, that can be a really brutal ride. That's why we absolutely need our second pillar, the safety net, SCHD. So while VOO is all about growth, SCHD is all about quality and cash flow. Think of SCHD as your psychological stabilizer. It filters for these rock-solid companies with really strong balance sheets and low debt. We're talking about companies like Pepsi or Home Depot. When the market is crashing, your natural instinct is to panic sell. But with SCHD, you get a dividend check deposited right into your account every single quarter. That consistent cash flow helps you stay logical when everyone else around you is getting emotional.
And this right here, this is the secret sauce. By automatically reinvesting those dividends, it's a process called DRIP. You start buying more shares, which then pay you even more dividends, and the cycle just snowballs. It compounds. Over decades, a massive portion of your total wealth won't come from your initial contributions, but from these reinvested dividends just doing all the heavy lifting for you. It's amazing.
All right, now for the pillar that most American investors completely, totally ignore. But let me tell you, it is absolutely essential. This is your insurance policy, and its name is VXUS, the Vanguard Total International Stock ETF.
This fund owns a piece of everything outside the United States. We're talking about global giants like Samsung, Nestle, and Toyota. So why is this so important? Well, you don't want your entire retirement tied to the fate of a single country's economy, its currency, or its political climate. right? Remember the lost decade from 2000 to 2010? The US market went absolutely nowhere, but a lot of international markets did really well. VXUS is your protection against that ever happening again.
And hey, just from a valuation perspective, there's a really strong case for buying international right now. This chart shows what's called price-to-earnings ratios, which is just a simple way to measure if stocks are generally cheap or expensive. And as you can see, international stocks are currently trading at a pretty big discount compared to their US counterparts. You're basically getting to buy your insurance policy while it's on sale.
Okay, let's recap. We have our engine, VOO. We have our safety net, SCHD. And we have our insurance policy, VXUS. Now let's put it all together and see how this simple logical strategy can actually turn into life-changing wealth.
There it is. That's the number. Over $1 million. And honestly, the best part is you don't need a stroke of genius, you don't need a lucky stock pick, and you certainly don't need a massive inheritance to get there. All you need is a sound plan and consistency.
Look, here's the math. It's simple. If a 25-year-old invests just $600 a month, that's about $20 a day, less than most people spend on lunch, into this 3-fund portfolio, assuming a pretty conservative 8 to 9% annual return, they'll have about $1.1 million by the time they're 55. That is the raw power of compounding and low fees doing their thing.
And at the end of the day, it all comes back to this one fundamental truth. Investing isn't about being a genius, it's about being consistent for a very, very long time. The goal isn't to be right once in a while, it's to avoid being catastrophically wrong for 30 years. And this 3-fund portfolio gives you a profoundly logical balance of risk and reward to do just that.
So there you have it, the logical path to your first million. It's simple, it's effective, and it is absolutely built to last. Now, we're curious to know what you think. Of the 3 pillars we covered, the engine, the safety net, or the insurance policy, which one resonates the most with your personal investing style? Let us know.